Session 4 for supply chain diligence, and we're going to look at learning outcome 4, the final learning outcome, which is understand the main performance measures of the supply chain. So it is completely about performance measures. 4.1 is critically assess the main financial measures that can be applied to measuring the performance of the supply chain. You'll note that says financial measures, then the unit content is measurement of costs, timescales, processing, quality and satisfaction, which are much wider than just financial measures. The other two bullets are financial measures such as profitability, return on investment, sales growth, cash flow, and finally the use of balanced scorecard methodologies. So quite heavy on content. Look at the questions that are being asked. This has been the most heavily examined area of the syllabus, and there has been 1, 2, 5, 8, 9, 11, 13, 14 questions asked focused on 4.1. Very few questions are being asked about 4.2 and 4.3. So you can see the breadth of the questions there. They're in the Word document, which I'll send you by email, and you can see how often they are being repeated. Very often. Some of them are up to 3 times, and on one of the other learning outcomes it has been asked 4 times. So a range of measures there being examined. So performance measurement: does the organisation understand which metrics are critical? Does it know the value of the information it could gain? How would having the information impact on some decision processes? So they're all factors in performance measurement. There are problems with performance measurement, that measures don't link to strategy, or that stop relating to strategy when the strategy changes. No meaning for the people who are supposed to drive them. Too many measures. Not enough measures. Measures focus on current state. Some backwards looking lagging and forwards looking leading measures are useful. You need a combination of both as per the balanced scorecard. So it's no good just measuring what's happened. You want measures that will predict future performance. What are the 7 deadly sins of performance measurement? Well, there's a very useful YouTube video there, and the 7 deadly sins are vanity, provincialism, narcissism, laziness, pettiness, inanity and frivolity. And that's not going to be asked in your exam, but it is useful background as to why performance measurement can have problems. Performance measurement culture is important. We need the right culture. We need accountability. People should only be measured on the things they can control. We need deification. Metrics are tests, they shouldn't be objectives. Burying the bad news: metrics will not work unless they promote objectivity, which means accepting bad with good. Delegating responsibility: performance is everyone's concern. Putting technology first: it is not the tools that matter, but the things they make, and neglecting to respect researchers and analysts. They need to be thought leaders within the organisation. So KPIs, benchmarks, encodings, qualitative judgments or categories are easily related to quantitative ranges and can be plainly displayed so that people can quickly understand. Range, strategy, targets and time frames are all terminologies used in relation to KPI. How do we develop then measurement systems? Determine the areas to measure, establish the measures, establish the standards for comparison, monitor, evaluate and implement improvement actions. So a standard 6-step measurement system development. Radar is sometimes used in assessment, particularly in the EFQM model, and it's about results, approach, deployment, assessment and review. So what the organisation achieves, what they're trying to do, how widely is it used, does the organisation ever consider how appropriate the approach is, and does the organisation measure the success of the approach. It's rather specialist theory that, and I'm not too sure how useful that is. I think the 6 steps on the other slide much more useful. Score is an important performance measurement in the supply chain, and it's the supply chain operations. Supply chain operations reference model is SCORE, and it's been developed by the Supply Chain Council, and it's a key tool in measuring and benchmarking in supply chains. It's based on performance attributes: reliability, responsiveness, agility, costs and assets, and it identifies 5 core supply chain performance attributes, which are reliability, responsiveness, agility, costs and the management of assets. The supply chain model again cannot be examined because it's not part of the unit content. It is only useful for suggested answers on how you may measure supply chain. The score metrics themselves are at different levels. There's level 1 metrics for the actual health of the supply chain. Level 2 metrics are diagnostics for level 1 metrics to identify root causes of gaps, and level 3 are serve as diagnostics for level 2. Time-based metrics then. So what metrics can we suggest if they ask you to outline time measures? Well, we've got agility, speed of response, compliance management, forecasting, product and service changeovers times, retail time to display, supply network design planning, time to market. So there are several sort of fairly generic time-based measures there. We can measure customer satisfaction, and that's often governed by recovery, the extent to which a dissatisfactory provision is corrected, adaptability, spontaneity and coping. They're all factors that influence customer satisfaction, and that's the same for there with a description of each word. So recovery is response to a failure or problem. Adaptability is obviously how an employee responds to customer needs. Coping is employee response to problems, and spontaneity is unprompted and unsolicited employee action. There is the ESCI model, which has been devised to measure and help understand customer satisfaction, and essentially what this is saying is image impacts on customer satisfaction, expectations do, perceived quality of hardware and perceived quality of humanware, which all lead to customer satisfaction. The perceived quality hardware comprises of product and service attributes, and the humanware represents the interaction with the customer, and customer satisfaction overall leads to customer loyalty. So it's a rather complex model which seeks to help you understand the determinants of customer satisfaction. It's on page 275 in the study guide, and 1 or 2 examiners' reports have said good answers also referred to the ESCI model to measure customer satisfaction. There is an EFQM model, European Foundation Quality Model, which is used for benchmarking, and it's got 9 key areas which are made up of enables and results, and this provides important areas for measuring quality, how well an organisation is performing, and you can self-assess or bring in consultants to benchmark using the model. So it is a very useful model. ServQual we've come across many times, and that's an important measure of service quality. One might even say a proxy for customer satisfaction, and it's the radar to remember it, and that's not laid out this well, this slide. So radar is the reliability, assurance, empathy, tangible and assurance, and the D is missing from there. Why is the D missing? There is a variable on that which I'll come back onto. So the ServQual model is about establishing gaps between what you expected and gaps between what you actually received. So sorry, the gap is if you expected the hotel you're going to would be very well decored, lush, plush seats, well kept, you might have been expecting 5, and if you went there and found it was a bit run down, you might rate it as 2 out of 5, so there would be a gap of 3. So ServQual is about establishing the gaps between what you expected and what you actually received. Areas to focus upon that affect service quality: users' personal needs, users' past experience, what users say to each other, service promises, how we see our service and role, and alternatives which the user perceives our. Right, more important now, I think, financial measures, how well the company's been run, and the key measures are profitability. CIPS would say cash flow as well. It's an important indicator, but not always as important as profitability. And in relation to how well it's doing for their owners, shareholder value as a concept is often used to describe overall performance of a company. It isn't just about profits, it's creating shareholder value. Financial objectives are often based around the shareholder concept, where the purpose of the organisation is to maximise value for owners. We could have sales maximisation as an objective, managerial income, consensus, wealth maximisation and best practice. And it's not the best of slides there explaining different objectives. We can see on this slide different types of profit. Essentially this is an income or profit and loss statement. The top line is the turnover, the money we've received from the year's sales. We deduct the cost of sales to end up with a gross profit figure, and if we then take the other costs, the overheads off, we're left with the operating profit. And there are various other deductions and names for profits as we go down, and the bottom line eventually is the profits that are attributable to the shareholders, and their profits can either be given as dividends to the shareholders or kept within the company as reserves. So quite complicated that, but it is a basic income statement showing you the layout there. Another very important statement in financial accounts is cash flow statements. These are where the cash came from and went in a year. So the very important section is the top one there, cash from operating activities. It's so critical that the business is cash generative. If not, the business is going to fail. So we'll look at that very carefully. And the middle bit is investing activities such as buying new equipment. So a negative cash flow there can be good because it means they're investing for the future. And the third section is financing activities such as selling shares, paying off loans or taking loans out. And again, that can be positive or negative. Then we add all three up to get a net increase or decrease, and we add it to the cash we started with. If we look at the Morrison's cash flow statement, we can see the business generated 978 million in 2017. They spent 282 on investing because it's negative in brackets, and they also from investing had a net outgoing of 857, but that still meant 161 negative for the year. But as they started with 487, they've still got a very healthy 326 millions available. So that's a very good example of a cash flow statement. The cash flow statement there's the plain explanation whether the cash in from the company's operating activities is increasing, we need to look at whether the company can afford to fund dividends, the amount of cash it's using for its borrowings, spending on fixed assets, the effect of any acquisitions, whether they'll need more funds, whether they've sold any shares, and it tells us the changes in the cash position. So a very important statement is the cash flow statement. Other measures that can be deduced from the company accounts, we can work out the gross profit percentage, we can work out the net profit percentage. Two very important measures, and obviously the gross profit percentage will be higher than net profit percentage. Couple more measures of profitability. ROCE, return on capital employed. So it's the profit before interest and tax divided by the average capital employed in the company, and it's expressed as a percentage. So obviously the higher the percentage, the better the return, the better the company is doing. It's getting more return on its assets, on its capital. We can also measure return on assets, which is profit, operating profit, divided by the total assets. You will not be asked to calculate that in an exam, but it's an important measure of profitability. But I think the gross profit, operating profit and ROCE are the three most important. Other measures which are more interested for the investors in the company: return on shareholders' funds, how much the earnings or profits after interest, tax and preference dividends are when they're divided by the ordinary share capital, times 100. So for the money that the shareholders have put in, that will give us a percentage figure on how much the shareholders' funds are earning. Other measures, particularly for the investors, can be dividend per share, dividend yield, earnings per share, dividend cover. That means how many more times the company had cover. So a dividend cover of 2 means they'd earn twice as much as they're paying out in dividend. And the price to earnings ratio is the share price divided by the earnings, and the higher that is, the more confidence investors have in the company in future profits. So some measures on shareholder, and there's the calculations. Dividend yield is how much dividend you get divided by the price of one share. So if you buy a Tesco share at £2 and they give you a 20p dividend, you're getting a 10% dividend yield. Dividend cover there is earnings divided by ordinary dividend for the year. Other measures that we can look at for the supply chain now: percentage markup, fixed order cost, total supply cost, average response cost, average transportation cost. So many sort of general costs there. The study guide gives a very strange theory or model from De Graven, Roodhoofs on mapping, cost identification. It is just trying to say there are different costs at different stages of a product's life cycle. Indicators and targets, revenue expenditure, goods and services purchased on a repeat basis, as opposed to CapEx, capital expenditure, which is buying capital equipment. So it's important to drill in and understand how much the spending of the revenue and how much of it is capital expenditure. There will be depreciation, maybe showing an interest expenses on a profit and loss account, and the supply chain contributes, or impact on that can be purchasing equipment, buildings, logistics networks, etc. Very important slide for groups of costs. There can be information costs, stocking costs, physical flow costs and transaction costs. So therefore areas of costs which are useful for an exam. How do we analyse costs? Well, they'll give 4 different approaches here, 3 of which are very sensible, one's a bit silly. Direct product profitability identifies the profit contribution of individual products by tracking specific metrics. So we've got direct product profitability, which is a very important measure in retail particular. Activity-based costing is an important method in industry for analysing costs and allocating overheads. So it assigns the organisation's direct and indirect cost to activities. So it's using costing as the name suggests, and you studied ABC costing, I believe that's in your negotiation module. There's the old favourite, the total cost of ownership, and then cips have put in this very strange one, efficient consumer response, which tries to link individual parts of a supply chain into a cohesive system, which it does, but it isn't really a method to analyse costs. You're trying to reduce costs and be more efficient, but I'm not sure that it's strictly an analysing costs, but it's there in your study guide, and it's listed as an approach. There's Little's law, which the amount of work in progress that any company has will depend on the throughput and the cycle time. I don't think we need to concentrate on that too much, but generally the longer the cycle time, the bigger the throughput, the more work will be in the pipeline. How do we improve capacity? I don't quite know why cips have put these slides in, so I think we'll ignore that one. Pooling decision can depend on volume, variability of demand and cost as to whether we pool together. More importantly, inventory, different types, anticipation, congestion, cycle, safety, working. So just terminology to do with inventory. Inventory costs are very important. Kaplan and Norton's balanced scorecard you should be very familiar with, you've done many times, and this gives a balanced view rather than just measuring financial profits. It looks at from the customer perspective, measures targets, initiatives, it looks at learning and growth, and it looks at the internal business processes to satisfy shareholders and customers. So it takes a hard and soft approach. It's got leading and lagging figures, and it gives us a balanced view of performance rather than the limited view of are we making any profit. And this expands a little more on that to give you one that's been amended to suit the purchasing. So this is similar, but it's got 5 boxes, you'll notice, one of which is suppliers, and the questions in each of the other areas have been amended to fit a purchasing environment. So a knowledge of the balanced scorecard is essential. It has been examined and probably will be again. You don't necessarily have to learn the adapted one. You would get away with knowing the standard Kaplan and Norton balanced scorecard on the previous slide. 4.2 then, supply chain strategy, determine outcomes, developing metrics and reporting structures. The study guide's pretty poor on this. You'll see from the exam questions there it's been asked 1, 2, 3, 4 times only, and they've asked the same question every time. So this is the only question in the question bank, and it's to do with why do we get stakeholder feedback and how do we get feedback? What mechanisms can we use? So while we're looking at this section, just remember there is only this one question in the bank, and it's to do with why we get feedback and how. So there are different types of stakeholders: internal, connected, external. How do we create win-wins? We need to create priorities, composite measures. We might need to satisfy. We might need to take sequential attention, and we might have to make side payments that some stakeholders get some compensation. Stakeholder power, expert, network, personality, resource, status. French and Raven, very similar to that. So why stakeholders might have. Why do we communicate and consult with? groups where we need to communicate our intentions, we need to consult, we need to communicate the results, and we need to consult on the results. So areas of consultation. There is a standard for reporting to stakeholders, but it's more to do with sustainability than general supply chain, although sustainability is very much supply chain related, and the AA1000 is based on principles of inclusivity, materiality and responsiveness. And stakeholder engagement's about planning, preparing, implementing, act, review and improve. So it's very much like the plan, do, check, act. So how do we communicate? Well, awareness, we might try and communicate to build general knowledge. We might try and communicate performance, impact of results, change management, or the communication program could be about knowledge transfer in the supply chain. So there are different focuses of communication. And how do we do it? Well, how long's a ball of string? Publications, newsfeed, memos, posters, training, knowledge bank, intranets, etc., etc. Reports, memos, informal conversations. So how do we develop metrics? Establish the outcomes that the stakeholder wants, convert them into objectives, develop the measures, frame the measures as targets, and reconcile the impacts, conflicts and contradiction between the targets. So very similar to the slide we did some while back on how to develop KPIs. Now if we're measuring supply performance or supply strength of a supply relationship, the strength of the relationship depends on the item being purchased. For some items we need high relationship strength, and some we perhaps hardly need any relationship strength. So the appropriate measures for a critical product are the quality of the relationship, whereas for a commodity type item or leverage item it's more about acquisition cost, and we might use quality, speed, dependability, etc. to measure performance. So that's quite a useful slide, I feel. Why do we communicate to stakeholders? To remind them about the reporting process, to persuade stakeholders, think and act in a way, to coordinate, to promote the efficient use of resources, to create identification with the reporting process. Now the study guide goes down the performance prism, which is rather an obscure and silly model of performance measurement. It's got one useful attribute, that it recognises that to develop a strategy doesn't come first and then measures. What we need to think about is what are our stakeholders' needs, and then look at how we're going to satisfy their needs and develop the right strategies, processes and capabilities. It is actually based on a prism, and each side has got the 5 facets: satisfaction, strategies, processes, but it's not a model that's used for answering any exam questions, but it can be used to help make sure you've got the right measures. So you'll have the right measures if you think about what stakeholders need first, and then develop the appropriate strategies, processes and capabilities following that. And that's how we do it. We ask them questions at each stage. What are the critical stakeholders? Who are they? What do they need? What strategies do we need? What are the processes? What are the capabilities? And what contribution do we require from our stakeholders? And you can watch that video down the performance prism, which is quite useful if you care to. So why do we obtain feedback on supply chain strategies? Well, it helps us in predicting and controlling. The feedback is needed to understand the links between cause and effect of actions taken within the supply chain, e.g. change in stockholding policy may have an impact on availability. Mutual understanding. This enables both supplier and stakeholder to understand each other's point of view. And perhaps critical reflection, where the company receives feedback and, having considered it, can make an adjustment to the operation. So it's almost experiential learning. It is reflecting and thinking what's happened. You could link that to plan, do, check, act. So that's an important mechanisms, complaints processes, communication responses, email, etc. Service standard monitoring, questionnaires, standard response forms, and formal and informal feedback opportunities. I'll try and get out of this. So the final learning outcome is 4.3, and it's simply benchmarking. What is benchmarking? Types of benchmarking and gap analysis. And of course the whole point about benchmarking is to establish what the gap is and establish performance improvement. Again, not many questions. There's only three types of questions asked on this. One's been asked 3 times, which you can see there. One's only been asked once, so that's a very dangerous question which could come up in your exam. They explain gap analysis and a typical performance measurement and improvement process which would lead to process improvement. And then the other question has now been asked 4 times. Internal benchmarking, difficulties in benchmarking. So only 3 questions are ever been asked, and one's only been asked once, so that second question is dangerous. So what is benchmarking? It's comparisons, reference point, requires work, but it's not about copying. It's establishing gaps and trying to set performance improvements. And I've got to be careful. So improvement can be to best in class, it can be up to exemplary, it could be better than average from your current performance. And it can take time to get up there. So you can see a very sort of simple graph showing commitment versus time. Benchmarking versus comparative analysis. Comparative analysis is more emphasis on explaining the differences. So benchmarking is a much deeper process than just comparing. It is categorising organisations to achievement rather than rank. Benchmarking considers a broader range of measures, and it recognises the effect of risk and uncertainty on performance, and it aims to identify causal relationships. Moreover, it's more reasonable and valuable to benchmark than just to compare. Problems though with benchmarking: needs technical skills. It tends to be backward looking. Companies may be measuring the past. Will companies ever get to best practice in every aspect, or do they indeed need to? The implication there is only one best practice. There might not be. The companies who select benchmarks can do well rather than those who need to do well. It can narrow your focus away from the big picture, and it can be difficult to find partners. All comparisons seem false, but you can self-assess. It can help further change programs can benchmark. It creates motivation for change. It creates a vision of what the company could look like. It provides evidence and data to inspire the change. It can help identify best practice to manage change, and it creates a baseline to evaluate the changes. So types, there are hundreds of them. This list is fairly common: internal, functional, process, competitor, best in class, international, world class, strategic. Don't necessarily need to learn all these. The unit content doesn't name all those. It just says comparisons with business units, competitors, or other industry players. Internal benchmarking though can be used if your organisation has got different units in different places in the country, or is large enough. It spreads and reinforces knowledge in the company. You should already have good communication with your benchmarking partner because they're part of your structure. Information should be more compatible than it would be using someone else. There should be fewer confidentiality issues, less time, fewer resources needed, and anything that is learned will carry with it the same systems and culture you already have. So benchmarking within NHS is very big at the moment, and that's an example of internal benchmarking where they're comparing prices for similar goods that they're paying and purchasing process. Auckland says to benchmark we need to plan, collect, analyse, adapt and review, and you do need to learn one model of how to implement benchmarking. This one's fairly straightforward: plan, collect the data, analyse the data, adapt and review. Kazaneki has a more detailed one, which is 12 steps, perhaps a little too complex, but it's fairly logical. Get commitment, develop the mission plan, identify your customers, do the research, find partners to benchmark with, develop your measures, get your questionnaire sorted, scrub and analyse the data, try and find best practices, site visits, present findings, monitor results. Benchmarking could be showing gaps between price, innovation, quality on where you need to be and where you are, so you can be realised. What makes it successful must be used as a continuous process. It's really part of continuous improvement. It's important to identify key processes and CSFs. It should be integrated into decision making and management, and benchmarking should be conducted by well-trained and supported professionals, so that's an important aspect of implementing. And the important slide is gap analysis, which has been the focus of one exam question. The whole point about benchmarking is to establish any gaps, and you'll see on there's an operations gap and a strategy gap. The operations gap exists because we're not doing what we are currently doing as well as we should. We could be more economical and efficient. But the strategy gap exists because we're not doing the right things. We could be more effective. Gap analysis examines the mismatches for the factors that give rise to them. Both gaps represent risk and vulnerability. Reducing risk and vulnerability is core. We close the strategy and gaps with performance improvement plans. Closing identified gaps is arguably the entire purpose of performance improvement activities. So, fairly obviously, benchmarking is about establishing these gaps and setting performance improvement plans to close those gaps. And obviously this is going to take time. And that's the end of this presentation.